I'm Scott Isdaner, and I'm joined with my colleagues, Lena Ritchie and Ed Doran from all of us in our tax group at Isdaner Company. And welcome this morning to what we hope will be a bit of an educational program. And also, we welcome your questions as we're going along. Although if we find the questions start eating into the time, we'll defer them till later on. We have a group of topics this morning to talk about. And it's going to be a little bit of a hodgepodge as we move through this. There was a series of legislative changes that occurred at the end of last year. I'm going to cover the topics that are there with respect to the legislation changes. And then what we're going to do is spend a little bit of time. Ed and Lena are going to talk to us about what the tax proposals are that have been issued to date by the five leading Democratic candidates, at least per the polls, and the five who were I guess I wouldn't call them winners, but the five top vote getters at the Iowa caucuses, for which we're still waiting for the final results. But it's if you're watching and following the election, you'll see that it's very close. Right now, I think Buttigieg and Sanders are neck and neck, as close to like 95% of the votes have been counted, and then Warren followed by Joe Biden and then Amy Klobuchar. So they're the five who we're going to focus on a bit later on in the program. So with that, I'm going to get into some topics dealing with the legislation that passed. Every year, at the end of the year, Congress has to do a flurry of legislation involving budget reconciliations, making sure the government can continue to function. And typically embedded in those pieces of legislation are provisions that deal with tax law provisions that were going to sunset or had expired. And the reason that there are annual provisions that do this is because the tax laws are written in a way to be revenue neutral or try to be revenue neutral. So when Congress passes provisions in the tax law that provide benefits to taxpayers, those provisions cannot be given forever benefit because it costs too much. So very often those provisions are designed to sunset or end at certain dates. And every year there's an outcry that this was a great provision, we need to keep it enforced, so we need to extend it. And it always becomes a battle through Congress to get these provisions extended, especially when you do not have a bipartisan Congress working together. This year, with respect to these final pieces of legislation, the laws were passed in a bipartisan manner. So that's a plus for this year. On December 19th, the final budget bills were passed, and embedded in those bills was a series of tax provisions, and I'm going to talk about them for a few moments this morning. The president signed those laws on December 20th, so it happened almost immediately, and as a result, we have legislation that extends provisions that were expiring. We had some legislation that dealt with disaster relief for taxpayers who were in federally declared hurricane zones. There was an IRS a law passed to impose on IRS some obligations on how they deal with the public. And the big story in this legislation was unrelated to that, but was the passage of a bill that had been circulating through Congress for some time to reform our pension programs and plans, including IRAs. And that act is called the Secure Act, and I'll address that last, but that will have some pretty far-reaching consequences. Almost all of it positive, absent one change that will not be positive, and that adverse change is designed to pay for all the other positive changes. So the first piece of legislation that went through was legislation that extended provisions that were expiring, either had expired or were going to expire at the end of 2018. And the new law, the extenders law, actually extends most of these provisions through 2020. So Congress won't have to come in and have to extend them into the 2020 tax year this year. This happens very often during election years when it's difficult to get bipartisan legislation through Congress at that time of the year. So the couple of things I wanted to highlight and mention with respect to the extenders, and there are many other items that were extended, but I think we're a little less focused on the broad population, but focused on more smaller targeted groups. There was a provision in the law that allowed income that was generated if debt was discharged from individuals who owned residences. In other words, their mortgage was discharged because of their financial condition. Typically, when debt's discharged, the income from that debt discharge is taxable. However, the law passed an exclusion from this for qualifying individuals, and this new law extends that exclusion through 2020. So up to $2 million of debt forgiveness for qualified principal residence debt continues to be excludable from debt. Hopefully for all of us and most who we deal with, they don't have the issue of having debt having to be forgiven with respect to their principal residences. But this came into the law earlier on when we had the huge downturn in the real estate market a number of years ago, and it's continued to stay now and extended annually. Another provision that was extended was many individuals, when they get their mortgages, have to pay what's called mortgage insurance premiums as an extra cost. And the law in the old days did not permit those premiums to be deductible. And it was changed to allow those premiums to be treated as interest. So that just like when you pay your mortgage interest and can deduct it, the mortgage premiums also were allowed to be deducted. This provision was extended. It does phase out, though, and as it always did, for taxpayers whose income exceeds $110,000. So it's designed for taxpayers at a more of a middle market and lower income level to be able to take advantage of this. One of the big changes is that the law a couple of years ago had been modified to deal with medical expense deductions on returns. Under the law until 2 years ago, you were only allowed to deduct your medical expenses if they exceeded 10% of your adjusted gross income. So if you made $500,000 of income on the front page of your tax return, or what the tax return used to look like, 10% of that is $50,000, meaning that the first $50,000 of your medical expenses were not allowable as an itemized deduction. When the Tax Cuts and Jobs Act was passed a couple years ago, that was reduced to 7.5%, but it was set to sunset again, and this law extends it. So now going through 2020, that threshold is no longer 10%, but is dropped to 7.5%, meaning that more medical expenses will be allowed for taxpayers that are incurring large medical expenses. There has been a provision in the law dealing with qualified tuition. Individuals that pay tuition have different ways of getting either credits or deductions, and you've always been allowed to determine which of those two types of benefits is more beneficial on your tax return. The ability to deduct these expenses had expired, but again, this legislation extends through 2020. What's an above-the-line deduction? A deduction you can take whether or not you itemize deductions for expenses up to $4,000 if your adjusted income doesn't exceed $130,000, and then it drops to $2,000 if your adjusted gross income doesn't exceed $160,000. These thresholds are for a married filing joint. They would be half of that if you were a single taxpayer or married filing separately. So again, these are designed for people at certain levels of taxable income, not the higher income taxpayers. So these deductions now will be available still. I'm not going to talk about racehorses unless anyone has a real interest in that. I put these in because we actually have clients both in this area that deal with these issues and also in the film and theatrical productions. But that's I'll skip through those. The empowerment zone issue is Congress passed many years ago provisions that gave tax benefits for companies that operate in what are called empowerment zones. There's been a lot of talk in the last couple of years since the Tax Cuts Act came in about qualified opportunity zones. These are not qualified opportunity zones. These are called empowerment zones. They've been in the law for a long time. The law extended the benefits for companies operating in those zones. They include things like 20% wage tax credit, liberalized expensing of the purchase of capital assets. There are special benefits if you use tax-exempt bond financing to operate your business. And it lets certain capital gains to be deferred for certain qualified assets if you're operating in one of these zones. The last item in the extenders that is of interest is provisions that were extended to allow individuals to continue to get tax credits if they make energy efficient improvements in their homes, whether it's windows, doors, skylights, roofs, or you purchase furnaces or boilers or water heaters that are energy efficient. Those credits that had been in the law that expired have been restored again through 2020. There are limits on all of these in terms of the dollar amount, the percentages, the phase outs, what your lifetime allowance is. I'm not going to deal with that today, but the availability of that has been extended.